Accounting students. So this is our third video, and it is for this Wednesday. We're talking about financial statements and a bit about debits and credits. So I'm in the four core financial statements section of the textbook, which is the end of chapter 1. And I'm going to go through the four statements, but I'm going to start at the bottom of the page here with the balance sheet. You will notice that this textbook goes into the statement of cash flows. We are not going to talk about the statement of cash flows in this class. You do not need to know it. You should already know a good amount about the balance sheet because we've had 2 classes on it as of now. And the main thing I want you to know is that these statements, they flow into each other. So the balance sheet has our assets and liabilities, which are things we own and things we owe, as well as our investment in the shareholders' equity here. And we've been calling this the statement of financial position. So again, balance sheet, statement of financial position, same thing. And the shareholders' equity here has a separate statement called a statement of retained earnings. And this is how we connect the balance sheet to the income statement, which is our new information for today. Basically, we have what we invested in the beginning into our business, right, at the beginning of the year. And then we add the money that we've made over the course of the year, or if we lost money, we take it out. And any money we've paid to our owners, which is dividends in this case. So dividends are money that the business pays out to people who have invested in it. And at the end, we have a number that is either higher or lower than what we started. So this business made money. It made a net income of 115,000 and it paid its owners 35,000. So it went from having an investment of 400 to 480. Really simple math here, and it says plus and less. So you're using words, not a plus sign or a minus sign. So you can see here, right? There's some good graphics if you want to see. So beginning retained earnings can either grow or it can shrink. And that comes from this net income number here, comes from our income statement. So an income statement is our new statement. It starts with revenues, which is money that we have made or we have earned throughout the period of time. And again, this is what we were talking about in class, right? This is a video. It's a period of time, a year ending December 31st. So balance sheet is again a snapshot. An income statement is a video, right? A movie for January to December. So all of the services we provided, any other revenue we've made, again, not the cash we received necessarily, but us earning that money. And then any related expenses we've paid out, and that's our net income. So our income statement flows into our statement of retained earnings, which flows into our balance sheet, giving us our retained earnings number down here. And they all automatically balance. So this is what the textbook is saying here in this paragraph. They are self-balancing. So no matter what you do, these statements as they flow together, they should always have an equal amount of what you own and what you owe if you do this properly. So you can see an example here of this flowing through. This is the same example as above. And this shows us how we have transactions flowing into this system. So this is the second part of today's lesson, which is debits and credits. This is very important, and we're going to use this in class. So accounting breaks things down into accounts. So, for example, this is a cash account. The definition of account is in this section here, so you can pause it and take that down if you'd like. An account is a place where related transactions fall. So, cash is an account where anything to do with cash, we track it in that way. You can think of it like a bank account. So, again, this account started with 50,000. They've collected some money. They made a sale, so it's increasing. And they paid rent, so it's going down. So we track all of the things that have happened for that account in this one space. This can work for any assets and any expenses, any revenue, any liability. These are all types of accounts. But by saying increase or decrease, we've really created a fallacy here in terms of our balance sheet. Because if you remember, our liabilities have to equal our liabilities and our investment have to equal our assets. If we were saying increase or decrease, it would start to be very confusing. So in accounting, we use the term debit and credit. So, sorry. So you can see here this graphic. This is what I'm looking at right now. Assets increase on our debit side. So debit is left. Okay, so just think of, if put your hand up, right, your left hand up right now. This is debit. They increase on the debit side, and as well as expenses, and we'll go through this in class, and liabilities and revenues, they increase on the credit side. Okay, they're using this mnemonic: dead debits increase expenses, assets, and dividends. Right? You can think of it the way that you want. And we are going to go through some examples of this in class, but right now you need to remember debit, right? Assets, expenses, and dividends. And credit are liabilities, revenues, and equity. And so, when we do this, this allows for what I was talking about before, which is the income statement flowing into the statement of retained earnings, flowing into the balance sheet. Because as you can see here, revenues, if they increase, they're a credit. They increase our retained earnings, which is a credit, which increases our shareholders' equity, which is a credit on the right side of our balance sheet. Now, I know you might be thinking this is very confusing, but don't worry, we're going to do a lot of examples in class tomorrow. So you should be able to, right now, distinguish between the financial statements and think about how they apply to our restaurant accounting. Thank you for paying attention.